All right. What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. And so basically, I came across a blog post from the New York Fed again, basically talking about how can safe asset markets be fragile, right? And it's kind of they're attributing safe assets to be US Treasuries, and then also its fragility being kind of reflected in the sudden spike in yields from March 2020, right? And so basically, what happened was there was like a 2 week period or something where yields just started to spike like crazy, according to this. And then basically, it's kind of their idea of why it happened and why it's going to become more frequent and that sort of thing, right? And it's actually mostly for two reasons. One, kind of selling, it seems like, well, obviously, um, but like massive selling in the treasury market. And it's kind of, but there's also something that I didn't think about with respect to the primary dealer banks, right? And their kind of balance sheet constraints. And that's part of their argument too, is in conjunction with this is why it'll become kind of more of a systemic factor, right? And so getting right into it, head over there. All right. So, using a theoretical model, they show that the markets for safe assets can be fragile due to strategic interactions among investors who hold treasury securities for their liquidity characteristics. Worried about having to sell at potentially worse prices in the future, such investors may sell preemptively, leading to self fulfilling market runs that are similar to traditional bank runs in some respects, right? And so basically everyone's trying to sell at the same time. Kind of, I mean, a typical market sell off, I guess you could say. Or I don't want to say typical. Um, almost in like the fact and almost in the same way as like you would see capitulation, I guess. Maybe not to that degree or for that kind of a I don't know how to word it. I guess kind of maybe not so much in a secular fashion, as you would see like a say like a dot-com bust in the 2000 or maybe like the GFC, to where it's basically it's down for a significant amount of time with respect to kind of markets in general, right? And you have to keep in mind the type of market it is in that respect. So like the paper markets like bonds and stocks and stuff are going to be down longer, or I'm sorry, not are not going to be down as longer as say like real estate, just because real estate moves a lot slower, right? So to continue, basically why. So first, the dealer banks that provide treasury market liquidity faced mounting challenges to their intermediation capacity. The chart below shows that dealer balance sheet space allocated to treasury securities increased both during the run-up in treasury prices and their subsequent crash. The recovery in treasury prices after March 18th coincided with dealer balance sheet pressure receding as the Federal Reserve's treasury purchases ramped up, right? Excuse me. And so here we have this chart where the blue is the treasury yields, and keep in mind this is a reverse scale, so the higher you are, the lower the yields, and so these spikes in yields are going to be seen by rapid kind of downtrends in it. So you see here in early March, and then kind of mid-ish March, where it gets to like I'll say 1.2% or somewhere in there. Um, and so on, right? So the spikes in yields are actually down. Um, and then the red line is the dealer's treasury holdings. And this kind of run up that you see is where it goes from, we'll say 1.8 trillion, and then it starts to go up to above 2 trillion, from basically the end of February into mid March or so. And then you can see really where this goldish line, the Fed's treasury holdings, um, where they start to significantly increase, the dealer's treasury holdings start to taper off back down to what they usually were, right? And so I'm not all too familiar with the nuances of the balance sheet constraints on dealer banks specifically, because I know like a lot of different firms, or types of entities, they have different regulations and so on. Um, so I don't know if basically the whole balance sheet constraint for them is basically how much like cash or cash equivalent, whatever they have, or how exactly their balance sheets are structured, so that they, because they're basically a market maker, right? That you have with stocks, right? Or kind of drawing an analogy in a way. It's just they're for treasuries, right? So like the Fed buys the treasuries for QE and so on from the dealer banks, right? And you can kind of see this dynamic to where it basically goes back down into um, its usual level, right? As it was before this kind of run up. Basically, the Fed's taking the treasuries away from the dealer banks. And one thing I want to kind of note is I think, at least my thinking is because you see kind of a more divergence with the Fed with their holdings, to where basically they just keep increasing, whereas the dealer banks kind of levels off back to where they were. And I think that's because since the dealer banks kind of play this kind of market maker role, I mean, they're basically continuously getting treasuries flowing in and out of them, right? Whereas the Fed, it's not so much, they're not like actively, I don't want to say trading because it's not a good way to say it, but they're not that interactive with the market to the same degree, right? And so basically, when the Fed buys the treasuries, they're essentially holding them to maturity, right? In this respect, at least on a kind of, we'll say, aggregate uh, scale, I guess. So basically, it's like they're holding the treasuries, but they're not really selling them off right away, or they're not like having other market participants come in and buy the Fed's treasuries, right? They have to, the Fed, in order to basically get rid of their treasuries, they have to um, hold them to maturity and they roll off, or they sell them through QE back to the dealer banks to go from there. At least that's what my thinking is, and maybe why you see this kind of larger divergence, where the Fed's treasury holdings keeps increasing up into 3.6 trillion or so, but the dealer banks um, comes back down to the usual trend. And I think that's kind of, I guess the best way to articulate it would be kind of like the different amounts of flow through them, right? So it's kind of like you have a regular river, I don't know, for dealers treasury holdings, whereas the Fed is more of kind of like you have a river coming into a lake and water just kind of congeals, congregates in the kind of lakeish area, whereas some of it may pass through, right? So probably not the best way to articulate, but whatever. So, secondly, the behavior of foreign investors and mutual funds. The main sellers of Treasury securities in March 2020 was very unusual. So, the next chart shows the net purchases of the two groups over time and highlights that their sales in the first quarter of 2020 were unprecedented, much larger than ever before. They even put a little box by it so you can see that first quarter of 2020 where it just plummets. So, there's that. And you can tell like the scaling, right? One, it looks like a major outlier. Two, it's like, this is what negative, we'll say 300 is in billion. Yeah, billions of dollars. It's of the same magnitude of one of the massive buying sprees that you see specifically with the left chart, which is no, foreign investors. I don't know why I was looking in the caption. But anyway, and with mutual funds, it's this to the same degree, but they don't nearly buy as much. So kind of showing where the different kind of net purchases lie, I guess you could say. Mostly with foreign investors, maybe because there's just typically more of them. There's more people than there are funds. Um, maybe. But I don't know. So Vising Jorgensen, this paper shows evidence that both groups' sales of Treasury securities exceeded their actual liquidity needs. The unprecedented magnitude of the sales and the fact that a considerable fraction of them were precautionary makes this behavior appear very similar to a run reminiscent of depositors rushing to withdraw funds from a bank, right? So basically, it's more of kind of an emotional sell-off in a way, to where they're all panic selling in a way, right? To the extent that they don't actually need the liquidity. It was more of to kind of appease the almost panic that I'm sure a lot of people, especially in March of 2020, were feeling, right? Especially in finance. So basically they were selling off a lot more than they actually needed for liquidity. Whereas if you see like kind of more of a GFC crash, um, the sell off is mostly because or for liquidity because they don't have it. And they actually draw that conclusion and comparison in a few sections, right? So first and foremost, safe assets are safe. Basically, they're going into why the treasury market is what it is, right? So, meaning that they're expected to pay their full par value at maturity with near total certainty. As a result, we typically observe a flight to safety during times of stress in which demand for safe assets increases, pushing up their price, right? And so, is kind of starting to getting into that strategic interaction that they kind of alluded to before, right? And so basically you have a flight to safety to where people are buying treasuries because it's dollar denominated asset, it's quote unquote safe, always pays par. um, it's a deep and liquid market, right? So you can basically um, the probability that you won't be able to pull your money out is significantly low, right? And I forget what podcast I was listening to or who, I think it was the Rebel Capitalist show. Um, I forget who the person being interviewed was, but he was like having a talk with a major foreign investor, I think Japanese, off the top of my head. It's been a while since I listened to that specific podcast. And he's basically like, why do you, with all these, he was asking this foreign hedge fund manager or whatever, basically like, why do you always invest in like US Treasuries, right? Why do you hold these as kind of like a cash equivalent? And he gave like this long argument about why like the dollar isn't going to last and that whole typical argument you see, and basically it's fiat, the dollar's a lie, that sort of thing, right? And then the foreign investors response was basically yes, but it's a deep and liquid lie, right? And so and basically it's comparing it to all the other fiat currencies on the planet, like it's the most, in terms of getting, when you're comparing or more concerned with return of capital rather than return on capital, instead of trying to make a return and increase the amount of money you're making, you basically just want to ensure that you will get that money back regardless. um, and so basically, especially when you scale up, there's a lot different problems that you have, I've noticed. And that's why you see a lot of the major investors and hedge funds and that sort of thing. They don't just put these as bank deposits, obviously. Like they basically hold them as T-bills in a way. So that because of this dynamic to where they're more likely, one's the counterparty risk, switching it from say a commercial bank or whatever happens to be, maybe it's a money market fund, whatever, into a basically pushing that onto the government, right? And I guess money market fund isn't exactly the best comparison to draw, but regardless. So you have this flight to safety, and that's why because the US Treasury market is what it is, it's so deep and liquid. And I think and that's pretty much the argument. That's why there's a flight to safety in there during times of stress, right? So to continue, second, safe assets. Wow, safe assets are liquid, kind of going on what I was just saying, and some investors hold safe assets to sell them when faced with sudden liquidity needs, right? Because they can pull that money out so quick, right? So let's see, their model, which builds on Bernardo and Welch, another paper, shows that the safe asset market is stable and well functioning as long as the market is sufficiently deep. Again, because there's so much liquidity or money in the market itself. Pretty sure the US Treasury market is the largest. It's maybe specifically with bonds. I don't know if you'd really throw on like derivatives on top of that because that's not really, I guess, where you see a lot of, I'm not sure how to word it. Basically, the major hedge funds and major, just we'll say, investor types lumping all that kind of smart money into it, right? You don't really see them aggregate or I guess congregate into the derivatives markets for the same reasons. And that's one thing I've noticed as I've been studying, not just investing, but like kind of the monetary system in general, is like it really, really depends on why the reason you buy something completely dictates when and why you'll sell, right? And not just holding it in general, right? And so like people will own, and that's one thing they get into in a second in the blog post is like they buy these treasuries for different reasons. And that's why you have these different dynamics at play, right? So basically, this model that they're talking about shows that a safe asset market is stable and well functioning as long as the market is sufficiently deep. To reiterate what I just said, in this case, flight to safety and dash for cash are complementary phenomena. This is kind of the two different reasons why you would buy treasuries, right? And so, with investors who buy the assets for safety, absorbing sales from investors who sell assets for liquidity, right? So it's kind of fulfilling each other, right? It's honestly a lot of this just seems like a typical market, like in general. So, however, in their model, the market can break down if trade involves dealers that are subject to balance sheet constraints. And so, this kind of makes me think of is you have basically two investors. It's a lot like the stock market in that respect, in terms of like how it works, or at least that's what it seems to be at first. And I'm pretty much only drawing the dynamic in general, not necessarily talking about comparing the assets themselves. And so, like, you have two investors and then a market maker in the middle, where in this case, the market maker is the dealer bank, right? And so the problem is that flow I was talking about earlier with respect to the Fed's holdings and the dealer bank's holdings of treasuries. And at least that's what pops in my head now. And so basically you have one side where investors basically they're flying to the treasuries for that safety aspect. And so they have a significant demand, but you also have the investors who are selling because they need liquidity, and so they have complementary needs, and that dealer bank is what basically is the intermediary for them, and is make sure that they basically that market remains liquid, right? And in order for that market to remain liquid, the treasuries and cash have to move, right? And so basically the balance sheet constraints can put a governor on that kind of flowing, right? On that movement, right? They can only move at a certain speed because they can only hold a certain amount of treasuries. And I think that kind of is reflected in the chart up here, where you see where it comes back down to kind of base. I don't want to say baseline, but kind of like a baseline in a way, because it seems like it goes up on the run up and then comes back down to approximately the same level. So there's kind of like in your car where there's kind of a running temperature. And so basically in terms of the balance sheet of the dealer banks, you basically have um, basically regular running temperature on your engine, and then basically in this run up it's running hot, and that's because there's something wrong. Like maybe I'm a bit into cars, so maybe like you have something wrong with your water pump or whatever the hell. And so basically you're not getting that flow like you need to, or that coolant like you need to. And so basically you're having this kind of your engine's running hot, and then the Fed has to come in and essentially take over. So like you have some redundant secondary system for coolant. Um, and that's basically what the Fed's role is in this dynamic, and that brings the dealer bank their balance sheet back down to an average, or the your standard running temperature, right? And so it doesn't really fix the fact that your water pump is broken or whatever the problem is. It just kind of reduces the magnitude of the situation so that it doesn't have to work perfectly, right? And so it's compensating. Now, secondary effects of that will be interesting to look into, and I think now that I think about it, it's something I'll probably look into further. But yes, so and this is why I never scroll. Just so you guys know this, because I always lose my spot. So, individual investors may prefer selling preemptively today if they expect conditions to deteriorate sufficiently tomorrow. Kind of common sense. So, aggregate sales today have a direct effect on the price today, but they also have an indirect effect on the price of tomorrow through their effects on dealer balance sheets, right? So there's a bunch of selling that basically the dealers have a lot more treasuries the next day, um, that they'll need to offload, and especially if there's no buyers for that, right? And so when others are selling today, an investor would rather sell today than wait and risk having to sell tomorrow, by which time dealers may be overloaded with inventory, resulting in lower prices, right? It's kind of, this reminds me a lot of inventory or real estate inventory, right? Where the prices are kind of set at the margin. So it's like, yes, you have these, I don't even know how many to be honest, but billions of homes or whatever. We'll just say 1 billion to give it a number, um, in the United States. But you only have, say, 1 million for sale. I know the numbers are drastically different, but I'm just kind of trying to show a concept in a way, or at least think through it. And so you basically have, say, 1% inventory, right? Of the total houses in the US, you have 1% of them for sale. And so basically, everything's kind of, all the prices for those houses for sale are basically based off of the 1 million that are for sale, not the other 999 million that aren't, right? And so you kind of have the pricing of future treasuries coming into the market are being priced based off of those dealer, the dealer's balance sheet, because that's what the inventory that's ready for sale is, right? And so if they have way more, the prices are going to decrease, right? Supply and demand stuff. But in if the other dynamic happens and there's a massive buying spree or whatever, and the dealers don't have treasuries, well, now there's more of a premium on that, and so the prices increase, right? So demand by flight to safety investors early on in stress episodes increases prices both contemporaneously and by relaxing dealers' balance sheets in the future. Kind of what I was just saying. So if the strategic concerns of liquidity investors are sufficiently strong, then additional demand for safety first investors today can induce liquidity investors to sell today because the prices are increasing. And so basically the liquidity investors, flip it around, sorry, the safety first investors have that additional demand, right? And so they're flying to that safety of the treasury market, they're buying up the treasuries, that sort of thing. And so basically the prices are increasing, which is creating that incentive for the people who are doing it for cash, the dash for cash investors, as they say. It increases the incentive for them to actually do that because they'll receive more cash for it, right? And so this can induce liquidity investors to sell today precisely because the market today has a relatively higher capacity to absorb sales, right? And so they can actually dash for cash. So, kind of going on a comparison of what made the March 2020 factor different than September 2008. Basically, their model highlights that the central role of dealer bank balance sheet constraints that may in part be a result of post crisis regulations. um, Second, the liquidity needs for the crisis appear to have been much larger, for example, because of the disruptions and the lockdowns globally. So there was more of a demand for it, or more of a need for that liquidity. Sorry. Um, and also the dealer banks had different balance sheet constraints apparently, or at least it's what it seems. And again, I'm not 100% sure on what exactly those constraints um, are that would have changed, right? And that's something I need to look into, but just kind of bringing that up. So, lessons, basically, what they gathered from this. So, however, the timing of policy interventions, always got to bring in government, and announcements can have large effects well before the interventions are executed. We show that an asset purchase facility can have a large effect upon announcement by shifting strategic investors from the run equilibrium to the hold equilibrium, even if the facility does not become active until a future date. All right, so kind of the whole forward guidance and anticipation, kind of using the Fed terms. Um, and I guess a lot of these asset purchase facilities are going to be those facilities that the Fed created, right? And so finally, their model shows that that markets where trading occurs in a decentralized, sequential way and where dealers play a large role in intermediating flows are inherently fragile. Changes to market structure whereby trades are pooled to reduce the role of dealers can therefore reduce the fragility of safe asset markets. So, kind of centralizing the treasury market in that respect to dealer banks, right? Um, that's what the argument is for. And now, what are some of the something like that, especially? Um, you'd have to do a significant cost benefit analysis of it, especially when you're talking about such a deep and liquid market, I'd assume. Um, but it's something to look in more into and to think about. So if you guys have anything about it, please feel free to discuss it in the comments, or if there's something I missed, whatever. As always, um, feel free to do that. And I will put a link to this post in the description so you guys can find it. I'll do the whole citation because they give actual like how to cite the post, and so I'll do those. And it always has the URL at the bottom, so you guys can go to it and read it yourself. And so yeah, stop the share, go over here. But yeah, that's all I'm going to do for this one. So I hope you guys have a good night, and I will see you on the next one.